Welcome to The Bull, your personal finance podcast. Another incredible guest has joined us today, and honestly, I could hardly find the words to describe the joy I felt when she accepted my invitation. We're talking about a living legend of personal finance in the United States, Christine Benz, Director of Personal Finance and Retirement Solutions at Morningstar US. I think I've read at least 100 articles by Christine, including her unmissable Sunday newsletter, so you can imagine the excitement I felt chatting with her about portfolios, asset allocation, retirement strategies, and much more. Christine recently published a book titled How to Retire, which is destined to become a classic in retirement planning literature, featuring contributions from giants like William Bernstein, Jonathan Clements, Ramit Sethi, J.L. Collins, just to name a few. Some of the countless insights from the book also guided our conversation, as well as the Morningstar study that Christine led on withdrawal rates for our portfolios. Without further ado, I'll leave you to my conversation with the fantastic Christine Benz. Enjoy the listen. Dear Christine, welcome to my podcast, The Bull.
Ricardo, it's such a pleasure to be here. Thank you so much for inviting me to come on.
Oh, it's great to have you here. I'm thrilled to talk to you about investing, portfolios, retirement, and all these topics we like to cover in my podcast.
Wonderful.
Christine, you're the Director of Personal Finance at one of the most respectful financial intelligence companies in the world. What timeless principles would you recommend for sound investing?
Well, one of the key pieces of advice, and it's so commonsensical that I think we almost never talk about it, but really it's the foundation for everything, is living within your means and setting an adequate savings rate. I think so often people look for their portfolios to do all of the heavy lifting, and the starting point has to be that you have a decent savings rate. Another key thing is just taking the time to take a step back and articulate why you're investing. I think, unfortunately, some people begin investing before they have really articulated that why. And the why and when you might need the money that you're setting aside is so important in terms of informing how you would invest the money. Specifically, that time horizon very much informs how much risk you'd want to take in the portfolio. So that's another key step that I would say is an underpinning of successful investing. Fees, of course, and I know you are a big believer in the importance of minding the fees that you pay, certainly for any investments that you buy. If you're buying any sort of managed investment product, whether a mutual fund or an exchange-traded fund, all of our research at Morningstar points to the value of low costs. In fact, if you were to home in on one single data point, the fees and low expenses in particular are more important than a fund's past total returns in terms of how likely it is to outperform its peers in the future. So minding fund fees, but also minding all of the other costs that you might pay, whether for the financial advisor, tax costs, that all of those things can drag on your return.
You get what you don't pay for.
Exactly. Jack Bogle put it so aptly. And Jack Bogle, of course, was the founder of Vanguard Group. And then finally, I was just going to say, keeping things simple, that using core building block investments tends to beat having a lot of smaller positions in a portfolio. And it also really reduces your ongoing oversight of that portfolio. So if you set up something that's quite simple and streamlined, that's a great way to lower your costs if you can be in broad market index funds or exchange traded funds. And then it also just reduces your need to be hands-on with that portfolio. It's very simple to figure out how to rebalance the portfolio, for example.
So very simple stuff makes 80% of all the story.
Totally, totally. Keep it simple, keep it vanilla. And I think sometimes people are surprised by that. In fact, I'm often asked by friends and family members like, "Hey, can you take a look at my company retirement plan and just assess whether I've done it right?" And sometimes my input is really like, "Oh, you could just buy the target date fund," which here in the US is just an all-in-one type fund that is meant to be age appropriate and goal appropriate. And I think my friends and family members are like, "Oh, wait, where's the secret sauce? Like, isn't there supposed to be something really like, can't you give me something really unique here? What are you doing with the good stuff?" Sort of is the retort that I sometimes get.
We are wired to look for complexity. If something is not complex, we tend to think something's not going to play out well.
Exactly. And of course, the financial services sector really sells into that sort of mindset that, the value proposition is often, we've got something complicated for you, it must be good. And that's not necessarily the case.
And what are the most common mistakes retail investors typically make with their own portfolios?
Yeah, one is, and I mentioned it in my response to the previous, Ricardo, but it's this idea of investing without a plan, where people just begin assembling these portfolios. Some investors are kind of like hobbyists, where they're like, "Oh, this one looks interesting, and so does this one." And so they begin compiling this group of investments, but they don't have an underlying plan. They don't have that goal set aside. They don't have a sense of their proximity to needing their money. They don't know their time horizon. So that's one key mistake that I see. Another, and I'm sure you see this as well, is just this tendency to want to assume that the past will repeat itself. So here in the US, we've had incredibly strong market gains. I think that there's a tendency to pile into the securities that have performed really well in the recent past with the expectation that their performance will continue. And of course, sometimes it will. There's a well-documented momentum effect in the academic literature that investments that are doing well oftentimes continue to do well for a period of time. But valuation is the other key component of what contributes to future success. And if valuations are high, as they sometimes are with securities that have enjoyed an extended run of success, well, that can certainly inhibit their future gains. So that's a mistake I see again and again and again. And unfortunately, I'm seeing a lot in the US market today.
So you are telling us that investing all in NVIDIA is not the right thing to do?
Well, if investors have taken my advice and just bought a total market index, they're getting a healthy share of NVIDIA right there, but you're also getting some exposure to other market segments. And that's how I would prefer that investors approach it. And then I was just going to wrap up by saying that oftentimes investors put together a well thought out portfolio that is in sync with their goals, but then they just step back and never revisit it. And there's a lot to be said for being quite hands off with your portfolio on an ongoing basis. But you do need to take a look at your portfolio and ideally take some risk out of it as you get closer to your goal. And so retirement is a great example. Many people who are getting close to retirement have had a great experience with stocks in their portfolios. So they might have portfolios that are mainly stocks, and they haven't added any safe securities. I think that's another mistake that I see quite often.
We tend to focus on the return, but the other side is the risk. How should one assess their risk throughout their investment lifetime?
Yeah, I think there are two components to this. One is, the traditional risk tolerance. Like, how does a period of bad market returns make you feel? Does it, make you feel sleepless? Do you feel like you want to change things up and move to very conservative investments at a poor time? So that's risk tolerance, and it's appropriate for sure. I mean, we should be thinking about it, but you also want to be thinking about what's called risk capacity. So how much risk can you take relative to your proximity to needing your money? So the person getting close to retirement is a really good example of this, where oftentimes people like that say they're in their 50s or 60s and they've been investing for a long time. Well, they're battle tested, right? They probably have high risk tolerance. They know that the market goes down and then it comes back up. And so they're comfortable taking equity risk and having volatility in their portfolios. The problem is, as they get close to retirement, they shouldn't have that all equity portfolio because their risk capacity has shrunk as they've gotten closer to needing their money. So I would argue that risk capacity is actually the more important concept to bear in mind. And it might sort of sync up with your age, but it might not. So an example would be, say you're a young person and one of the goals that you have for your money is to buy a home. And so you want to set aside some of the funds to buy that home. Well, yes, you're a young person. So for your retirement assets, your very long-term assets, you should have a lot of risk in that portion of the portfolio. But for this home fund, for this home buying fund, you'd want to be quite conservative because you probably don't want to wait 2 or 3 decades to buy it. Right. You probably want to do it within the next 2 or 3 years. So your risk capacity there is quite limited. So the two concepts, both risk tolerance, how you feel about risk, and risk capacity, how much risk you should be taking relative to you needing your money, those are two separate and important considerations when you're figuring out your risk capacity.
Interesting. Thank you so much. A way to mitigate at least the specific risk of the portfolio is diversification. For example, international diversification. Here in Italy, many investors allocate 60 to 70% of their equity portfolio to the S&P 500. Yeah, we have this kind of reversed home country bias here. And the rest, the remaining 30 to 40% internationally. In the US, it's common to see 100% allocated to the domestic stock market. It's understandable because of the huge gap between the S&P 500 return and those of the other developed countries. What is your perspective on international stocks diversification?
I am a believer in it. It's a controversial topic here in the US, but I do think that U.S. investors' overweight of U.S. stocks is part of what we were talking about before, where there's this hindsight bias in play, where investors believe that the strong performance of U.S. stocks will continue in perpetuity. Valuations suggest otherwise, where we see the gulf between U.S. and non-U.S. valuations, with U.S. stocks being more expensive overall. Their dividend yields also tend to be lower. And so I would argue that for investors who are kind of setting their allocations, whether they're in the U.S. or outside of the U.S., I think the global market capitalization is a halfway decent starting point when figuring out how much to invest in your home country relative to the rest of the world. So when we look at the U.S. market today, it's something like, I want to say, 55, perhaps closer to 60% of the total global market cap. To me, that's a reasonable starting baseline where you're sort of looking to other market participants to inform what's reasonable. I think that that's a good starting point. And that's particularly true for younger investors. We live in a global world. Our economies are increasingly linked together. It seems to me that you should want to benefit from great companies wherever they happen to be domiciled, whether in the US or outside of the US.
I think it's hard because we have this hindsight bias, recency bias. Imagine someone who started investing in 2010 and did all the right stuff. Diversification, S&P 500 plus international stocks, etc. And the neighbor invested in the Nasdaq 100. He made a ton of money and you are left behind. It gets difficult to firmly believe you have been doing the right things and resist from making stupid mistakes like, now I sell off my portfolio and I bump into MicroStrategy.
Right. Which is why, we should not benchmark ourselves based on our neighbors' returns, right? I think people can really get themselves into trouble. And probably the neighbor's not giving you the whole story of how they've actually performed, that they might have had some really great components of their portfolio and some things that they've not done as well with. But yes, I think that's a huge component of this strong home country bias that a lot of U.S. investors feel today. One quick point is for people who are getting close to retirement and getting close to spending from their money, arguably they should back off from the non-U.S. diversification a little bit. So say I'm a U.S. investor, I plan to retire in the U.S. and spend U.S. dollars in the U.S. In that case, I probably do want to have a little bit more or perhaps substantially more U.S. exposure because of that foreign currency risk that is embedded in my non-U.S. portfolio component. So that's something to keep in mind. Life stage plays a role.
The classic 60-40 portfolio, 60% US stocks and 30% treasuries or US aggregate bonds, has long been the benchmark, with the capital B. Recently, critics argue that the historical success of the 60-40 was due to a 40-year period of declining interest rates starting in 1981 with Paul Volcker head of the Federal Reserve, when interest rates peaked at 19% at that time. That fostered negative correlation between stocks and bonds, which is great because when stocks fall, the Fed cuts rates and bonds somehow compensate for it. Now we have a higher correlation after 2022, and some believe portfolios should include different asset classes such as gold, commodities, alternatives, and so on and so forth to accomplish a real diversification. So the question is, do you think that the 60-40 portfolio is dead, as someone says, or just needs some fixing along the line?
It's an important question, but I sometimes think when I hear people trash talking the 60-40 portfolio, I kind of look around and say, okay, what are you selling? Because oftentimes it is the people who are the biggest naysayers on sort of a very minimalist portfolio like the 60-40 portfolio is, they're selling some complex alternative that is often higher cost. And so that's one hesitation that I have in saying 60-40 is dead, that I think that sometimes people who are most aligned with talking it down are selling either a product or a service that is a competitor to a 60-40 portfolio. I do get the point that there will be environments where that basic portfolio won't deliver. And you referenced, Ricardo, 2022 as a perfect example of that, where the same thing that was bugging the stock market, higher interest rates, was also bugging the bond market in that year. So we saw a fairly rare decline in both major asset classes. I would say that in many other scenarios, when stocks decline, high quality bonds and U.S. treasuries in particular are very nice ballast. And I think that there are a couple of reasons why you would expect that ballast to be persistent. And one is that the U.S. Treasury bond is viewed as a safe-ish store of value relative to other assets that in, flights to quality, like the beginning of the pandemic, for example, in March of 2020, we typically will see treasuries perform quite well during periods of, kind of fear, for lack of a better term. And then the other thing is that oftentimes in recessionary environments, when stocks are flagging, the Federal Reserve is pushing down on interest rates, which boosts bond prices. And so I think those two things will tend to contribute to bonds, and especially high quality bonds, roles as ballast, as diversifiers for equities. But I would also say that investors should take care to globally diversify their portfolio, that you definitely don't want to hunker down with an all U.S. stock, all U.S. bond portfolio. I would take care to own non-US investment assets as kind of my next best diversifier for the portfolio. In terms of alternatives, there are so many different types of investments that fall under that alternatives umbrella. Some of them have done a better job of providing diversification for that 60-40 portfolio. To the extent that I added something like that in my portfolio, I'd probably be looking at good old-fashioned cash as a starting point, so sort of as my next additional asset to protect me against a 2022 style environment. And then if I wanted to add some additional true alternative asset, I would look to something that has a really low expense ratio attached to it, because that's an issue with some of these alternative investment assets. At the end of the day, their performance looks like something between a stock and a bond, and yet their expenses are much, much higher than you might pay for any of those plain vanilla asset classes. So to the extent that people want to delve into alternatives, I would just really keep an eye on the fees.
So you believe the backbone of one's portfolio should be made mostly of stocks and bonds. International diversified, but still stocks and bonds.
Yeah, and for people who are in decumulation, who are actively spending from their portfolio, I think they should have some cash too to protect them against a 2022 style repeat, which, we're talking about realistically here in the U.S. next year. Not that we would necessarily see a fall in stocks at the same time, but I think there's some worries about inflation and in turn rising interest rates for 2025, I should say. It's this year. It's now.
Okay. Nowadays, there's a lot of talk about things like private equity, private credit, private infrastructure, these fancy stuff for institutional investors that now are somehow available to private investors too. Private credit in particular is something that scares me, for example. There's a lot of talk about it. It seems the ultimate problem solver, high return, low risk, if we can say it. What's your opinion about these alternatives that are not listed on public markets?
Yeah, they, I think, have been viewed as kind of a magic bullet here in the U.S., especially in a lot of kind of pension portfolios where there isn't, a need for daily liquidity or anything like that. Private equity, at the end of the day, to my mind, is equity. And you may see somewhat lower volatility, but Cliff Astis, who is an alternatives investment manager here in the U.S., has called it volatility laundering. That funds don't, they're not required to report their performance daily in the way that a U.S. mutual fund would be, and so there's a lot that we probably miss in terms of the volatility inherent in their return patterns. So I don't think that smaller investors necessarily need to run out and add those assets to their portfolios. I'm not sure, even though the past return profiles of private equity have been higher than public equity, I'm not sure that it's repeatable, and I'm just not sure that it's a must-have for smaller investors' portfolios.
Thank you so much. So let's assume things go well for the 30-plus year accumulation phase. What are the most important steps to take as one approaches retirement?
Sure. So one of the key ones, which I've alluded to in my responses to a couple of your other questions, is it's really important to start de-risking that portfolio. So so you've had a good experience with equities, but you don't want to roll into retirement with an all equity portfolio. So that's not to say that you shouldn't maintain ample equity exposure in retirement, but you should begin to add positions in cash, in high quality fixed income securities. Ideally, you would do that kind of gradually in, say, the 20 years leading up to retirement. But if retirement is, say, a few years away, it's not too late to start de-risking that portfolio. And the key thing that you're doing there by bringing lower risk securities on board is that you are protecting yourself against what is called sequence risk in retirement planning circles. And that basically means that bad returns show up early in your retirement. And the problem with that sequence risk is that if you are spending too much from a portfolio that is simultaneously dwindling, you're leaving less in place to repair and recover when the market eventually does. So mind that sequence risk by taking risk out of the portfolio. And then another thing that I think sometimes gets lost in the shuffle is the importance of maximizing your non-portfolio sources of cash flow. So people may have pensions available to them. In the US, we have a government program that we've all, as workers, have paid into called Social Security. The specific parameters of these programs vary by the country where you live, but the basic idea is if you can enlarge those non-portfolio sources of cash flow, it takes so much pressure off the investment portfolio. So I think investors should focus their energies outside of the portfolio before they turn their attention to specifically how they will allocate that investment portfolio.
The retirement portfolio's asset allocation is a huge topic, both for professionals and in the academic research, and I'd like to talk to you about 3 examples of retirement asset allocations. In your book, the great William Bernstein champions inflation-protected bond ladders with TIPS, the Treasury Inflation-Protected Securities. And Scott Sitterbook, on the other side, for example, made a remarkable, highly controversial paper in 2023, which Cliff Asness didn't like at all, suggesting a 100% stocks allocation would be the safest one. And the third one is Michael Kitchis, who suggests a V-shaped glide path, reducing risk once one approaches retirement, but then increasing the equity exposure going on to offset the risk of sequency that you talked about before. What's your opinion? What is the sweet spot between these 3 very different perspectives?
I don't think there's a single right answer, which is one reason why in my book we included a link to Wade Pfau's questionnaire that helps people home in on the right sort of portfolio construction, the right sort of retirement income solution. So it notes that we're all geared a little bit differently in terms of what we're wanting from our retirement cash flows. You might have some retirees who say, what appeals to me is a high degree of certainty, similar to what I had when I was working. I want to kind of simulate that paycheck in retirement, in which case William Bernstein's laddered Treasury inflation protected securities portfolio might appeal to someone who is very safety minded like that. On the other hand, you might have other folks who say, well, I really want to maintain ample equity exposure in my portfolio throughout retirement. I'm comfortable with equity risk. I want the optionality that comes along with managing my portfolio on an ongoing basis. That's something that I don't necessarily get with that laddered TIPS portfolio. So I do think a bit of introspection is important in this context, that if people can either take Wade's questionnaire or just kind of take stock of what you're looking for in terms of your retirement income, that can help you find your way to the best portfolio solution for you. And then another point I would make on this front, Ricardo, is that it does depend on your non-portfolio sources of cash flows. So going back to this idea of someone who retires with a full pension that is supplying them with all of their cash flow needs, which is kind of a luxurious position to be in. But there are people who do have that setup. Someone who's in that situation, all else being equal, should be able to take a lot of equity risk, right? Because so much of their cash flows are coming through these non-portfolio income sources. So that's another reason why this is so individual specific, that it's really difficult to say this one prescription suits everyone, because what we're looking for might be different. And also the contours of the rest of our financial plans might be a little different too.
So the answer maybe is more psychological and individual related than financial in a strict sense.
I think so. I think of myself, I've been someone who has always worked in the context of an employer-provided paycheck. I've never been an entrepreneur. I've never had any lumpiness in my household cash flows. It's all been related to my paycheck. So when I move into retirement, I want something that feels a lot like the paycheck I had while I was working. Someone else, say an entrepreneur or a person who works on commissions, for example, might say, oh, I've always been someone who likes to roll with changes, with variability in my cash flows. I'm fine with some lumpiness in my cash flows as long as my portfolio will continue to grow. So I do think that it does depend on our psychology and also just kind of the trajectory of our cash flows prior to retirement.
I understand that you are a proponent of the so-called 3-bucket strategy. Could you please explain what it entails?
Yes, this is a way of looking at retirement asset allocation where basically you're organizing your portfolio by your expected spending. So in the 3 buckets that I often talk about, you are setting aside roughly 2 years worth of portfolio withdrawals in true cash investments, which have no risk attached to them, maybe a little bit of inflation risk, but the time horizon is short, so that's not a big deal. And then you're stepping out on the risk spectrum. So you hold another 5 to 8 years worth of portfolio cash flows in a high quality fixed income portfolio, short and intermediate term bonds. You do have a little bit of risk in this portion of the portfolio, but you also have a higher return potential, a little bit more protection against inflation risk. So with those 2 components of the portfolio, you've got anywhere from 7 to 10 years worth of cash flow set aside in safer assets. So if stocks fall and don't get back up as they did here in the US in the 2000s, the idea is that you would be able to pull from those safer assets without having to touch your stock portfolio. And then bucket 3 is the kind of the growth engine of the portfolio. It's where you're going to hold a globally diversified stock portfolio. And this is anything else that you have in the portfolio beyond that 7 to 10 years that we just talked about. So the funny thing is when people run through this exercise and say they're about to embark on retirement, what it often backs them into is kind of a 60-40 portfolio. If they do this math and they're doing like a 4% spending rate from the portfolio, well, if I've got 10 years of those portfolio withdrawals in bucket 1 and bucket 2, well, that's 40% right there. And then I've got 60% in equities.
So the idea is to have somehow 3 different asset allocations according to different risk horizons or risk tolerance profiles, and then build up an overall portfolio with 3 layers according to these different criteria, a sort of goal-based approach.
Exactly. And that's not to say you'll necessarily spend from the portfolio in exactly that sequence. So, for example, after 2023 and 2024, my thought is that most retirees would probably want to be pulling from their appreciated equity assets for their cash flows. Leave the safe components of the portfolio alone because your equities have done well. Your cash flows are hiding in plain sight in that component of the portfolio. In 2022, when we talked about stocks and bonds were both down in the US, well, there's where your cash comes in for an environment like that. And then there might be other environments where stocks don't perform well, but bond prices go up, and in which case you might pull from that portion of the portfolio. So the idea is that you're kind of taking a step back every year and saying, well, where does it make the most sense for me to go for my cash flows for the long-term health of this portfolio? And that's going to be a year-by-year decision, I would think.
Okay, very interesting. Thank you so much for explaining it. The $1 million question when it comes to retirement is how much I can spend from my portfolio. How much can I withdraw from my portfolio? Every year, Morningstar delivers an outstanding study about the so-called safe withdrawal rate and covers a lot of topics about retirement planning. Would you please briefly introduce this year's study and explain why Morningstar thinks the safe withdrawal rate might be lower than the classic 4%?
Yes, this is some research that we've been working on, I think, for now 4 years now. And the idea is to take a little bit of a temperature check because many people have heard about the 4% guideline for safe withdrawal rates. It was some research that was originally developed by financial planner William Bengen back in 1994. And he was looking at historical returns and basically saying, okay, if I have kind of a balanced portfolio, what was
50-50.
Yeah, 50-50. What was the most I could have taken out as my starting withdrawal over the worst period in market history? And I believe he homed in on kind of the mid to late 1960s period as the starting point and found that, okay, if you happen to hit this Armageddon of bad market environments, 4% still would have been supported over the subsequent 30-year time horizon. Our research is meant to be forward-looking, so we embed our colleagues' capital markets assumptions into our discussion of what a new retiree could safely spend. And the problem for U.S. retirees today is that U.S. stocks have been really, really good, and bond returns are looking a little bit better because interest rates are better, but mainly because of the weaker equity return expectations. Our thought is that new retirees should be a bit cautious if they're just embarking on retirement today, that they should be taking a little bit less from their portfolios, or at a minimum, be prepared to kind of tap on the brakes. If a bad market environment materializes, you'd want to be prepared to take a little bit less. So that was why in our most recent research, we thought that a 3.7% starting safe withdrawal percentage looks to be a safe percentage. I would just say part of that very low number, which I think is dishearteningly low, does rest on the fact that most portfolio balances are actually elevated today. So lower percentage, but on a larger pool for many investors. So that's, I think, one reason why retirees shouldn't be completely dispirited by our research. And then the other key point I would make is that in our base case that we use in our research, we assume that someone's going to take out X percentage in the first year of retirement and never again revisit that portfolio withdrawal. So if I can get 3.7% and I say I have a $1 million portfolio, well, that's $37,000 in year one of retirement. Then I'm just going to inflation adjust that dollar amount thereafter. But I'm going to basically keep blinders on with respect to how my portfolio has performed. Well, that necessitates a very conservative spending system. The good news is that retirees are able to kind of pick their heads up and say, oh, is my portfolio up or is it down? If it's up, maybe I can take a little bit more. If it's down, maybe I need to take a little bit less. So it's kind of a superpower that retirees have that really isn't addressed in any way, shape, or form in that base case that we use in our research.
In your book, if I don't get wrong, Jonathan Guyton talks about the guardrail strategy, which is a strategy to optimize the withdrawal rates along the retirement lifetime according to how the market performs. How does it work in practice?
Well, so it's a rules-based system that does adjust withdrawals up or down based on how the portfolio has behaved. So it's similar to a system that we use here in the U.S. called required that dictate how much you need to take out of your tax-deferred accounts every year. It's basically the basic system is life expectancy, is portfolio value divided by life expectancy. The guardrail system kind of fine tunes that a little bit because it puts an upper band on how much you can take out in a really good market environment like 2024. And then it also puts lower bounds around how low your withdrawals could go in a bad market environment. So it's meant to help address lifestyle considerations that inevitably accompany retirement spending programs.
I do like Barry Ritholtz, who wraps up the main takeaways at the end of each of his podcast episodes. So keep it simple, stocks and bonds still make the portfolio's backbone. Think about risk in terms of both tolerance and capacity once one approaches to retirement, and be flexible when thinking about how much one can withdraw for a own portfolio, and everything's gonna be alright. Do you agree with me?
That's a wonderful summary. I totally agree. I would throw in keep an eye on costs because those are of a corrosive effect on your portfolio's returns. But overall, that's a great summary.
Christine, thank you so much for all the valuable insights you provided us with. It was a huge pleasure to have you here.
Oh, the pleasure was all mine, Ricardo. Thank you so much for asking me.
Bye-bye.
Bye-bye.
And that's all, folks. I hope you enjoyed the episode and that it gave you some further insights into how to better manage your financial planning. I don't know if it's the same with you, but whenever I hear content that I might already be partially familiar with, but from such an important figure, I always gain new understandings. In the introduction to her book, which you can find a link to in the episode description, the legendary Jonathan Clements writes that Christine is a leading voice on retirement issues. And I already knew that. But he also adds that she is a wonderful person. And I can personally confirm this due to the extraordinary kindness and availability that this equivalent of a star in the world of American finance showed toward our podcast. Before we part ways, I invite you as always to follow us and turn on notifications on Spotify, Apple Podcasts or wherever you listen, and leave a 5-star review to support us and allow us to continue producing content that helps you understand how to set up your portfolios through competent and wonderful people, always bringing in new insights. That's really all for this episode, and we'll hear from each other again next Sunday with a new chapter of our journey together in the world of finance. Right here, of course, with The Bold, your personal finance podcast.